What we'll see out of China is a continuation of what we've seen over the last 2 weeks, and that is policy fine-tuning as opposed to major stimulus. The government has indicated they're not about to undertake a major stimulus program, but we have seen steady announcements coming from the government and the central bank which point in the direction of easing. For example, in the last few days, they cut the reserve ratio requirement for regional banks. And there has been moves to sort of step up the pace of spending on infrastructure. So those sorts of moves I think will probably continue, but I'd call that fine-tuning. It's aimed at preserving growth at around 7.5% rather than pushing growth back up again. Well, there's no doubt that the Ukraine situation remains fairly tense. There was some hope a week or so ago that maybe there'd be a diplomatic solution, but there's obviously been a setback on that front over the last few days. So that remains a threat to markets. My feeling, though, in this environment is that investors probably should maintain an overweight exposure to equity markets, but maybe not as much as they had, say, 12 months or so ago, because markets aren't as cheap as they were 12 months ago. So it's still an environment that favours growth assets, favours shares, but just not as much as the case as there was 12 months ago. And I would then be using any dips in markets that might be triggered, for example, out of an escalation regarding Ukraine as a buying opportunity to top up that exposure. In terms of commodities, I think it's a mixed bag. Commodity story, I think, is a messier one. Yes, there is a case to be overweight oil and agricultural commodities and maybe some industrial commodities like copper. But generally, I'd play it on a case-by-case basis rather than having a general overweight to commodities. I think the reality is that the worries about emerging market currencies haven't gone away. They've gone into abeyance, if you like, because it's become clear that the Fed is still a fair way away from raising interest rates. But as we go through the second half of the year, I think there'll be more and more talk about when the Fed will start raising interest rates as the tapering process comes to an end. And that in turn, I think, will see renewed pressure on emerging market currencies. And that includes the Indian currency. The rupiah, I think, will remain or will resume its downtrend over the course of the next 6 to 9 months as more talk emerges about when the Fed will start raising interest rates. I think the earnings results this reporting season, it's going to be a difficult reporting season. Reliance will probably do okay, but the reality is that in an environment of sluggish economic growth, subdued consumer demand and rising interest costs and relatively high inflation, that profit growth is going to be somewhat subdued compared to what might have been the case over the last few years. So overall, I think the report's probably okay, but probably not enough to justify or support the share market at these sorts of levels.